Something is cooking. Can you smell what America's cooking? If it's not cooked right, well, the pressure cooker could explode. We're talking about bonds, international bonds, international bonds, Look, from the biggest economies outside the USA, Japan, Germany, the UK, heck, even Australia, the Aussies are getting on out too. They're straight up exploding. The yields are spiking, the market is feeling the heat, and it is a big effing problem. Before you say, well, it's not my problem, I don't want to tell you it's probably your problem. You might want to stick around a bit because this affects crypto and really everything, whether you like it or not.
Okay, but what are bonds? Boring ass bonds.
Bonds are fixed income assets issued by governments or companies in exchange for a certain interest rate for a certain amount of time. It's basically an instrument that says, I owe you money and I'll give it back to you after a stipulated, agreed date. And of course, I will pay you a little bit of extra in return. Pretty simple concept. Bonds issued by governments are considered to be one of the safest assets in the world because, well, governments don't go broke that often, especially when they're issued out by powerhouse economies, the USA, Japan, Germany, UK, France, right? These countries are, in theory, always going to have the ability to pay their debts. Unless, of course, the issuing country completely collapses. Which is why, bonds from the Central African Republic are probably pretty high risk, right? But Lark, what if it happens? What if the big country bonds collapse and they can't pay it back? Well, if a major economy like the USA, Japan, or Germany collapses, then we're going to have much bigger problems than the bond markets. It's going to be an everybody problem. The problem will be in between what is for dinner and an airplane-sized asteroid about to drop on your city. Slightly different problems, right? I know you have another question in your mind. Why the hell does the government even need bonds? They already have taxes. Yeah, I know, and taxation is theft. Well, for one, taxes just don't cut it. Almost all countries rely on debt to plug budget gaps. They just spend too damn much on too much dumb shit, for keeping it real. But they also want to fund big ticket items, stimulus packages, all kind of stuff, so they're constantly issuing out new debt. And there's also another reason, and you'll hate central banks more when you learn about this. You see, over the long term, inflation erodes the purchasing power of money, your money, because you don't get to front run the inflation like the banks and all that and the government do. Now, $1 million loan today won't hold the same value 20 years from now due to inflation. That $1 million in 20 years is going to be a lot different. By the time the government pays back the bond principal in the future, that $1 million will likely be worth much less than it would be today. If we assume 2% annual inflation to the money supply, then you're seeing that much debasement. This is the reason why you shouldn't expect inflation to go away anytime soon, because guess what? High inflation works in favor of the government. But today is not the day to discuss that. But you know what? If you want me to open that can of worms, I'll make a separate video on it. Just let me know down below in the comments. But before we get into the next part of this conversation, why the bond situation is so crazy, I want to take a moment to let you know how you can get $50 for free with Femex. One of the top crypto exchanges. Look, markets go up, markets go down, but you can trade both ways and make money both ways. Even if it feels a bit dirty making money shorting sometimes. And the OG exchange, Femex, is a great place to do it. It's available to everyone, everywhere. It has deep liquidity, all the top trading pairs. And currently they're running a crazy promotion that you may want to take advantage of. So you get $50 for free just for signing up using the link down below. You'll get a 20% deposit bonus. So you deposit $1,000, get $200 back, as well as a $1,000 trading bonus. Pretty damn cool, right? All you have to do, use the link down below to start your account, and you'll be eligible for all of those bonuses. Go check it out if you're a trader and you want to be trading in the markets and taking advantage of that offer, but also of all the trading opportunities available. Let's get back on the topic of global bonds here. So global bonds right now are experiencing a sell-off as investors react to Trump's tariffs and the German paradigm shift. Yes, let's break it down. German bond yields recently saw their biggest daily jump since reunification in 1990. But why? What's going on in Germany? Well, Europe's biggest economy plans to reform debt policy and ramp up defense spending, and it's sparked a bond sell-off due to fears of oversupply. This caused the bond prices to drop, yields to spike, a chain reaction that also impacts other economies. And Germany does need some stimulus. They've really been in a rough situation for a few years now due to the ongoing sort of problems in Europe. But let's break this down. Germany, unlike the US, has what you call a debt brake. It actually prevents the country from borrowing more than 0.35% of its GDP. This was created to prevent overspending and keep debt under control, which, a fine and dandy idea when you think about it. Sounds very responsible. However, critics are saying it restricts necessary investments like in infrastructure or in defense. And to work around the debt brake, Germany plans to create a special fund outside of the regular budget. This fund will invest 500 billion euros, half a trillion, over 10 years. Other reports say it could even be up to $1 trillion by the end of it. So whatever the number is, it's a bazonkers amount. Let's put it that way. Now, a big part of this fund will be used to strengthen the German military. It seems like Trump's 4D chess has actually indeed got countries worried about U.S. security guarantees and if aid will continue indeed flowing to allies. So countries are now figuring out how to take care of themselves. And surprise, surprise, the answer is by going into debt. Of course it is. Well, this stimulus is being described as a game changer. It could actually be a bit of a double-edged sword.
But, Lark, the stimulus is good, right?
Oh yeah, pump that money, baby. Let's go. Money printing is good for risk assets like crypto. Indeed. But to answer that in a bit more detail, we need to learn how bonds actually work. You see, there are 3 simple terms we have to remember: price, interest, yield. Now, the yields of bonds, they are going up right now because the price of bonds is going down. Now, I know that sounds a bit confusing, but just try to take this example. Look, if I were to go and buy a bond originally priced at $1,000 with a fixed interest of $50, so that's a 5% yield. But if for some reason the price drops down to $900, well, I'll still get the $50 since that's fixed, but the yield percentage spikes to 5.55% from the original 5% because I'm now paying less money to get the same 5% return, or $50 return, which is now a higher percentage yield. Now, looking at Germany, the yields are exploding because the stimulus plan requires the country to borrow money. This caused a sell-off because of concerns about oversupply. The sell-off affected the bond price negatively. However, even though the original reason for the yield increase was actually the dropping price, the cheaper bond prices and the higher yields will eventually make bonds more attractive to a wider range of investors, possibly, of course, drawing more funds into those bonds. Now, look, I said a few minutes ago that it's a double-edged sword, so let's unpack that a little bit. The stimulus package that will be funded by the bonds will boost the sluggish German economy, which, of course, could then stimulate domestic demand. Good. Stimulate economic growth. Good. One of the biggest economies in the world. Fantastic. All sounds great. On the flip side, the rising bond yield will suck liquidity from risk assets like stocks and crypto, at least in Germany. To some extent, other countries or investors from other countries may look at those and go, oh, maybe we invest in Germany now. If we think about it some more, if the bonds don't get sold, the government won't have the necessary funds to fulfill its promises for a stimulus, which would result in, of course, stagnation and potentially worsen the current economic situation. On the other hand, if the bonds do get sold, then we see a situation where crypto and stocks could suffer from the liquidity crunch. Now, this is just Germany. You think, oh, Germany, it's not that big of a deal. Yeah, it's happening to a lot of countries right now. Look at the bonds in Japan, look at the bonds in Australia and the UK, and on and on and on. We're having a global bond crisis right now. And it's kind of a damned if you do, damned if you don't sort of situation. It's bringing a lot of uncertainty, again, into markets. Just, you didn't understand. Germany's not the only one dealing with turbulence. Okay, now the USA, of course, right now is playing its own super high stakes game with bonds where Trump's literally trying to crash the U.S. economy and the U.S. stock markets to force bond yields down to make sure that the Federal frickin' Reserve, man, that they lower interest rates to restart the housing market, to restart or to spice up the business cycle, all that kind of stuff. Trump's Treasury Secretary Scott Bessent, his general strategy is basically laser focused on boosting demand for U.S. treasuries to drive down borrowing costs. There's a lot of ways that they can do that, through just straight up alpha mog bullying to providing more incentives and making better deals and stablecoin regulation, one of the biggest buyers of U.S. treasuries, by the way. There's a lot of speculation about the potential U.S. treasury strategies aimed for boosting demand for U.S. treasuries, which could help drive down the overall borrowing costs. Now, some of these ideas include things like, encouraging banks to hold a little more U.S. bonds, man. It's just fine and dandy. Encouragement's fine and dandy. Reaching out to foreign buyers like China and saying, China, we're sorry, okay? We know we said some bad things. We were a bit drunk on, all that liquidity. Can you buy some bonds from us, please? It'd be great. Look, if demand for bonds increases, bond prices rise, yields decrease. as the fixed interest payment remains unchanged, again, as we described. Additionally, of course, there are rumors about possible debt swaps, aka trading expensive US bonds for cheaper alternatives. Alternatives that could potentially help to cut the overall interest payments and also to help to stabilize America's debt situation. We talked about stuff like the 100-year bond linked to gold and such stuff like that. But this is all pretty speculative right now, not officially confirmed. Okay, the Mar-a-Lago Accords, the great currency reset, but still just rumor. And time will tell if these are real suggestions or if these rumors will just be rumors or if they'll become a reality. Now let's take us to the most important question. Your dog coin bags, okay? Should crypto give a damn about any of this? The short answer is yes, obviously. As we've very definitively proven over the last few years, anything happening in macro 100% affects crypto. The long answer, it's a bit complicated. The global bond market is walking a tightrope right now, and the stakes really couldn't be much higher. If Germany's stimulus package and the US's demand-driven strategies end up succeeding, well, cool. Could we then see a prolonged economic expansion? The golden bull run. A big hurrah. Everyone gets wildly rich. But one misstep, whether it's oversupply in Europe or faltering demand for US bonds because of a whole variety of reasons why that could happen, any of that stuff could send huge shockwaves right throughout the financial system because everything's incestuous these days. No country's isolated. Somebody in China sneezes, the whole world gets sick. Pun sort of intended. Anyway, everything is linked, and dysfunction in one place can create dysfunction everywhere. Now, there's often flare-ups of dysfunction. Most of it gets handled pretty quickly, but sometimes it doesn't. Nothing usually happens, but then sometimes it does. And crypto, like other risk assets, does not exist in a vacuum. It's tethered to global liquidity. It's tethered to global investor sentiment, whether people want to risk on, risk off, the economic stability, the US stock markets, the US economy, the global economy, all this kind of stuff. The bond market may seem like a distant and super boring cousin to crypto, which is so damn exciting and volatile and crazy, and we lose our minds, but it's fun. We're all addicts and we just keep coming back. But its moves dictate the rhythm of the entire financial system, so do keep an eye on it. Bonds are the biggest asset class. Well, I guess second biggest asset class in the world after real estate. So keep an eye on it. This is the proverbial canary in the coal mine here. Thanks for watching.